Hey guys, it's James and I'm back with another valuation video. Today we are doing Johnson & Johnson, or ticker symbol JNJ. We're going to see with the current free cash flow numbers from 2021 back to 2012 what type of valuation we would get using the discounted cash flow model, Graham's model, and the dividend discount model. Now, if you guys want to follow along with this calculator, it is offered over on Patreon, as well as my compound interest analysis calculator or future value portfolio predictor. But today we are looking at the valuation spreadsheet. We're going to do discounted cash flow for J&J. First off, we need all of these things right here in the white. Like most of my calculators, all the inputs are in the yellow and all the outputs are in the green. Over here, we're going to have to first off, to do this DCF model, find the 10 years of free cash flow, and we do that by going over to macro trends for Johnson & Johnson's free cash flow. Come down here to the bottom for 2012 all the way to 2021, 13.9 billion all the way up to about 20.4 billion. So I have all of those numbers already put into the calculator. For the perpetual growth rate, if J&J were to go off until infinity, what would you expect their overall growth rate to be? About 1.5. Discount rate, about 8%. And total cash and total debt are the two final numbers you need to get the DCF model. And we do that by going over to Seeking Alpha. Now, I do have the premium subscription for Seeking Alpha, and they do give you a little bit more insight into the different dividend stocks that you'd like to purchase. If you guys want the Seeking Alpha premium subscription, and I do believe they are offering it all off about $100 to $200 off the current price, link in the description. So to be able to get that cash and total debt, 34 billion and 32 billion, you come over to J&J under valuation, scroll to the bottom, and you have your total debt and total cash, or cash and cash equivalents. Put those into the calculator, and the calculator will tell you that for the DCF model with these cash flows, J&J is valued at around $169.49. For Graham's model, all you simply need, I know there's a little bit more that goes into Graham's model, but it is all calculated right here in the formula, taking all that it needs, and all you have to find is an expected growth rate over the course of the next 5 to 10 years and the AAA corporate bond rate. You can find the AAA corporate bond rate on Google, and currently it is around 4.2%, and the growth rate for Graham's model, we are expecting it to be about 4% per year over the next 5 to 10 years. You can find just a quick snapshot of what the analysts are saying over in Yahoo Finance. For Johnson & Johnson, come over to the Analysts tab. Down here, next 5 years, Johnson & Johnson, 3.65%. I went ahead and put 4% in for the Graham's model. That gives us about $82 per share for Graham's model. Now, the dividend discount model is going to be our largest valuation, only because J&J has been paying a dividend for close to 60 years, and they've been paying a very good dividend. The dividend payout is $4.52, and the 5-year dividend growth rate is around 6.03%. Where do we find that? Again, we can find that over on Seeking Alpha, and there is a link in the description if you want to sign up for Seeking Alpha premium subscription for a discount. Annual payout, $4.52. 5-year growth rate, 6.03%. Dividend payout, 5-year growth rate, and the risk-free rate, or technically the 10-year bond yield. You can just find that on the internet, 3.6%. And then return of the market, anywhere from 8 to 12%. Now, if you don't do the dividend discount model correctly, it will come out negative. So you do have to understand what you are putting in here, and it could flip on you where the 5-year dividend growth rate is higher than the return of the market, which could give you a negative number. So you do have to know what you are doing for the dividend discount model to come out with a positive number. So do a little research if you're starting to get a little negative number here. So now that we have these three valuations, we'll come over here and we do want to apply a margin of safety. And we usually start around 25%. So let's see what that gives us. Let's go ahead and evaluate. And the average valuation is actually $207.78 with a 25% margin of safety. That gives us $155.83 per share, and that is with a 25% margin of safety. So currently JNJ is a sell. Now if your margin of safety was not as high, let's say you had a longer investing time horizon, say 25-30 years, you probably would be more safe going towards the 5, 10, or 15%. If we do 15%, then that does trigger JNJ as a buy, but only slightly. $176 as your final valuation, and the current price being $175, so slightly a buy. And we come over to our premium subscription for Seeking Alpha, and we do see that the Seeking Alpha author ratings are averaging it to be a buy, as well as the Wall Street ratings average it to be a buy as well. So let's go ahead and come over to our watch list, and for JNJ, coming here, taking this figure, $176.61, putting this in for Johnson & Johnson, $176.54, and that does trigger this valuation column right here to say take a look, because the current valuation or previous valuation is lower than today's price. So if we continue to look at this chart every single day, and we see that Johnson & Johnson has continued to stay under the price, Johnson & Johnson could be something that we could add to our portfolio. So with that, that finishes today's video. If you guys want this spreadsheet, you can head over to Patreon and sign up. It's only $7 a month, and you get my future value workbook, or my compound interest calculator, my dividend portfolio tracker, and my budget tracker. And if you guys are interested in a Seeking Alpha premium subscription, you can sign up, link in the description, with a huge discount as well. So with that, thanks for watching.